Hi, I'm Linda Eedes. I'm going to give you an update on the RECM Balanced Fund. I'm going to look at the first quarter of 2017, how markets performed, the impact that that had on the fund itself, and then talk a little bit about how the fund is currently positioned. So if you look at the first quarter of this year, the fund again outperformed its benchmark. It returned 3.4% over the 3 months, and remember the benchmark for this fund is South African inflation plus 5% over a year. So that shift to value and in favor of value investors such as ourselves has continued. That obviously started in January of 2016, and in fact the RECM Balanced Fund is up more than 30% since that turn actually came about. We think that's set to continue, and the reason for that is that there are quite a few sort of tailwinds which kind of support that going forwards. The first is really just the extreme dislocation that we've seen between value as an investment style and other investment styles. We know value as a style should outperform over long periods of time. That hasn't been the case over the last few years, and that's sort of kind of normalizing as we speak. And then of course we have to think about why that dislocation came about. So the main reason was this sort of artificial repression of interest rates that we saw by monetary authorities across the globe in a bid to sort of reflate asset prices artificially after the financial crisis. So that's starting to unwind. We're starting to see interest rates starting to creep up. It's certainly that downward pattern that we saw can't be replicated because they're already low, but even with regards to them staying as low as they are, that in itself is improbable, and that's further supported by a lot of sort of data that's coming out now. We've got quite a lot of buoyant sort of economic data, and that's in fact the reason why sort of global equity markets have performed very well over the quarter. In fact, the headlines are all sort of about growth and positive sentiment, and more about inflation and rising interest rates than about sort of deflation and interest rates going lower. So as I mentioned, equity markets were very strong during the quarter, and that's not only the developed economies like the US and Europe, but in fact emerging markets were actually the top performers, and South Africa followed suit despite the fact that we obviously had a lot of political noise during the quarter and there was expectations of a credit rating downgrade, which did come to pass. So emerging markets really benefited from this sort of positive sentiment with regards to global growth, with regards to Asia, and that saw industrial metal prices rising quite strongly, and that had a knock-on effect for, quite frankly, any company which had emerging market exposure, which had resources exposure, predominantly industrial metal prices exposure. And so within the context of the RECM Balanced Fund, that was, for instance, companies like Standard Chartered, which obviously has a strong emerging market focus. It was all the resource businesses which have their fortunes linked to industrial metal prices like Anglo American, BHP Billiton, Antofagasta, Merafe Resources, Centula, and then of course some of the luxury goods companies that we hold in the portfolio, such as Richemont on the US side, Coach, Hugo Boss, Swatch. All of these businesses saw a bit of a rally in their share prices on the back of emerging markets looking a lot more sort of positive and growth sort of looking a little bit more likely in those areas. As I mentioned, South African equities did surprisingly well. There, it was mostly the resources stocks that caused the market to rally, but also a mixed bag within the industrials. So some industrials companies did do well, but the more sort of domestically oriented businesses or sort of South Africa incorporated businesses did sort of get a bit knocked by the political uncertainty. So despite the fact that there was no real negative fundamental news, you saw their share prices drifting low, and I can only imagine that that was related to maybe a little bit of negative feelings with regards to the domestic environment itself. Banks were also off, as you might expect. That was obviously as a direct result of the credit ratings downgrade. That saw Standard Bank down a little bit, which is one of the holdings in the portfolio. But it also gave us the opportunity to introduce a new stock to the portfolio, which is Barclays Africa Group. And we also introduced Grand Parade Investments as well. And that's a business which has sort of been struggling with some management issues and really struggling to convince the market that it can deliver acceptable returns on some of the brands that it's bought, like, for instance, Burger King and Dunkin' Donuts, Baskin-Robbins, and the like. So looking at the positioning of the Balanced Fund currently, the overall asset exposure is still tilted towards equities. There's about 56% exposure if you combine local and global stocks. The overall equity allocation has decreased slightly over the quarter, and that's largely because we have pulled back a lot of those resources exposure. The companies that I've mentioned all saw their stocks continuing to rise, and with those discounts to fair value narrowing, it obviously makes sense to realize some of those gains when that happens. So the fund now has about 29% of its equity exposure in resource stocks. And what that means is that it's a lot more diversified now than it was 2 years ago, when, quite frankly, resources were really the only area of the market that was very attractive. So at that time, about 40% of our equity exposure, even slightly above that, was in resource stocks. Now, it's under sort of 30%, as I mentioned. And that's very positive, because it means the opportunity set is wider. It means we're not as reliant on any one particular investment theme being proven right within a particular frame of time. Just generally, obviously, sort of the more diversification you have, the better it is and the more robust your portfolio. You can see too that in the top 10 stocks, there's a real mixed bag of value opportunities. You've got investment holding vehicles such as HCI, RECM and Caliber, which we believe are both hugely undervalued. You've got the two biggest platinum producers. You've got Implats, Amplats, which we believe still offer value. You've got telecoms company MTN, which has had its fair share of negative news, was once a very much loved company at the top of its game. Now sort of everyone thinks that they can't do anything right. We believe that the truth is sort of somewhere in between. A local bank, Standard Bank, which I mentioned, chemicals group Sasol, which was sort of negatively affected by energy prices being down, and Portuguese retailer Sonai. You've got, of course, sort of local turnaround situation, technology group Altron, and then, as I mentioned, we do have some luxury goods exposure, and here you can see Richemont coming to the top of the 10. And that is a good representation of the rest of the portfolio. So it is really a very nicely diversified portfolio at this point in the cycle, which, as I said before, is really desirable. If you can find the right stocks across different sectors, high quality businesses which are trading at attractive prices, and they're in different themes, different geographies, different sort of industries, that's always more desirable than a portfolio that's highly concentrated in any one area. We're still a bit cautious about increasing exposure to the traditional interest-bearing investments like bonds and property, and that's despite the fact that yields have risen in the quarter. They're just not quite where we need them to be to justify a larger allocation. And yes, I mean, given what I've said about interest rates at the beginning of this discussion, we're very cautious about anything that's priced off the interest rate curve. And that includes, sort of the likes of insurance companies as well. As I mentioned, rates have been kept low artificially for a very long time, and we think that there's a lot of risk in that unwinding. Also worth mentioning is the fact that we still hold quite a chunk of cash in this portfolio. You can see it's about 38.2% now, and we think that's appropriate. If you look at the risks in the current market, we are struggling to find those businesses that are both high quality businesses and very significantly undervalued. We're not going to compromise on sort of the quality aspect of the portfolio. We want a portfolio that is tilted towards high quality businesses. So we don't want to just invest in the lower quality businesses in order to have equity exposure. And in this kind of environment, having the dry powder that cash affords you is a real advantage. So we're very comfortable with that level of cash in the portfolio. We think that's completely appropriate for a Regulation 28 balanced fund of this nature. So to conclude, the RECM Balanced Fund is a very robust, diversified portfolio of local and global value opportunities. We've seen that sort of shift to value started to happen. It's happening very, very strongly. That started obviously sort of a year and a half ago. We believe that is set to continue in terms of an overall theme going forward. Might be a bit bumpy along the way, but we think that there are a lot of tailwinds which look to be very beneficial for value investors, and of course RECM as well. And the main reason why RECM is positioned very well to deliver excellent returns for investors is that we have the widest opportunity set available to us. Being a smaller asset manager and having the willingness to invest in value. So that comes with the philosophy. I think we've proven that we are prepared to stick to the value philosophy throughout, some very challenging times. We will stick and be consistent to that philosophy. And then, we have the ability to invest in value opportunities sort of across the entire South African opportunity set. And then obviously within the context of the sort of 25% allocation to global, we can look there for also great, high quality, but undervalued value opportunities as well.